Picture this. You have a $5,000 credit card limit. You spend $2,000 on furniture. You have the cash sitting in your bank account. The bill arrives, you pay it in full, same day. Zero interest. Zero late fees. You did everything right. 3 days later, your phone buzzes. Your credit score just dropped 28 points. This happens to millions of Americans every single month. And almost nobody knows why. Today, I'm going to show you the exact date on your calendar that's destroying your score and how shifting a single payment by 48 hours can be the difference between a good score and an exceptional one. Pause. Look into the camera. Stay until the end because I'm giving you a 5-step protocol you can execute tonight before you go to bed. We're taught from childhood, pay on time and you're golden. That rule gets hardwired into our brains like gospel. And in terms of avoiding fees and interest, yes, it's true. Pay by the due date, you're fine financially. But here's where it breaks down. The credit bureaus Experian, TransUnion, and Equifax are not watching a live feed of your bank account. They don't see you pay off your balance the moment it happens. The credit scoring system is not a live stream. It's a series of photographs. And unfortunately, the photographer almost always takes the picture right when your room is at its messiest days before you actually clean it up. Here's the real timeline. Let's say your billing cycle runs from the 1st to the 30th of the month. All month long, you're swiping groceries at Whole Foods, gas, dinner out, Amazon. Your balance is climbing. On the 30th, the cycle closes. The bank generates your statement, that PDF email you get. This is the critical moment. The statement closing date. Whatever balance is on that statement is the number the bank sends to the credit bureaus. It gets locked into your credit report for that month. Your due date isn't until roughly 25 days later. So you might carry a $3,000 balance on the 30th, which gets reported even if you pay every cent of it on the 20th of next month. Edit. Animated timeline statement closing date reported to bureau's due date. The bureau sees high utilization. Your score drops. And you have no idea why, because in your mind, you paid perfectly on time. You're living in real time. Your credit score is living on a 30-day delay, based on a snapshot taken before you made your payment. If you don't control when that snapshot is taken, the bank is dictating your creditworthiness based on your worst day of the month. You might be thinking, okay, but does it really matter if they report $3,000 versus $50 as long as I pay it? Yes, massively. Here's why. Credit utilization makes up 30% of your FICO score, nearly 1/3. It carries more weight than the length of your credit history, more than your mix of credit types. Think about that. 1/3 of your entire financial reputation is based on how much of your available credit you're using right now at the exact moment the snapshot is taken. The math is simple division. Your current balance divided by your credit limit. If you owe $2,500 on a $5,000 card, you're at 50% utilization. And that's a problem. Here are the thresholds you need to know. Under 10%, excellent. This is where people with 800+ scores live. Under 30%, good, but not optimal. Above 30%, the algorithm flags you as a risk. Above 50%, serious warning zone. Above 90%, your score is in free fall. Edit. Clean bar graphic with color zones green, yellow, orange, red. I've seen people with 800 credit scores drop into the 730s because they booked a family vacation on a card with a $1,500 limit. No missed payments, no new loans. Just one utilization spike that crossed the threshold on the statement date. They checked their Credit Karma app, saw the drop, and assumed identity theft. It wasn't. It was just cold math. And here's the most important thing. Utilization has no memory in FICO 8, the model most lenders use today. Unlike a missed payment, which haunts your report for 7 years, utilization resets completely the moment a new balance is reported. You can fix a utilization problem in 30 days or less. Let's call this the statement date strategy. It's less of a hack and more of a timing adjustment that 95% of cardholders never make. The concept is simple. instead of waiting for your bill to arrive and then paying it before the bill is generated. Step 1. Find your statement closing date. Not your due date, your statement closing date. These are two completely different days, and your bank loves to hide one of them from you. Your bank's app will scream the due date at you because they want you to pay. To find the closing date, go to your Statements tab, open a past PDF, and look for Billing Cycle End Date or Next Closing Date. Write it down. Set a recurring calendar reminder 3 days before that date every single month. That 3-day buffer matters because bank transfers can take 1 to 2 business days to post. Step 2. 3 days before closing, pay down your balance manually. Open your bank app on your reminder day. Let's say your current balance is $2,400. You want your statement to show $50. Manually initiate a payment of $2,350 right now. Don't wait for autopay. Don't schedule it. Do it immediately. 3 days later, the statement closes. The bank sends $50 to Experian, TransUnion, and Equifax. The bureaus see you using less than 1% of your limit. Your score reflects a responsible, low-utilization borrower. Step 3. After the statement closes, pay the remaining balance. Your statement arrives in your inbox. New balance, $50. Minimum due, $25. You pay that $50 before the due date roughly 20 days later. 0 interest charged. 0 late fees. Maximum credit score impact. This is a 2-step payment process that completely decouples your actual spending from what the credit bureaus see. You control the snapshot. Now, a lot of people hear this and think, okay, I'll just pay everything down to 0 before every statement. 0 balance, perfect score, right? Stop right there. Consistently reporting a 0 balance across every single card can actually result in a lower score than reporting a small balance. The system penalizes you for looking like a ghost. Here's why. The scoring model is designed to evaluate how you manage debt. If your report shows $0 owed month after month, the algorithm has no data on how you handle repayment. In the eyes of FICO, a person who doesn't appear to use credit is slightly riskier than a person who uses it responsibly and keeps it low. FICO data shows that people with 850 scores, the highest possible, carry an average utilization of 4% to 7%, not 0. There's a strategy called AZEO All 0 Except 1. If you have multiple cards, pay all of them to 0 before the statement date. On one card, your primary card, pay it down so the statement reports a tiny balance, something like $10 to $20, or roughly 1% of the limit. This tells the algorithm, yes, I use credit, and yes, I keep it extremely controlled. And before you ask, leaving a reported balance is not the same as carrying a balance and paying interest. You still pay that $10 or $20 in full by the due date, 0 interest. You're just threading the needle between the reporting date and the payment date. Now here's the dark side. There's a way to abuse early payoff strategy that can get your accounts shut down entirely. It's called credit cycling. Here's what it looks like. You have a $5,000 limit. You spend $5,000 in the first week of the month. You pay it off mid-month. Then you spend another $5,000. Pay it off again. By month's end, $15,000 has run through a card with a $5,000 limit. To your bank's risk department, this looks like money laundering or bust-out fraud. They gave you a $5,000 limit because that's the exposure they agreed to. By cycling, you're forcing them to absorb 3 times that transaction volume. This can trigger an account review, a sudden limit decrease, or a full account closure with 0 warning. The fix is simple. If you keep hitting your limit and needing to pay it down just to keep using the card, you don't need a payment strategy. You need a higher credit limit. Call your issuer. Tell them you pay in full every month and you need more room for everyday expenses. Most issuers will do a soft pull and increase your limit without affecting your score. A higher limit makes everything easier. If your limit is $20,000 and you spend $2,000 a month, that's 10% utilization automatically in the excellent range without any manual intervention. One more thing you need to know, and this is where the game is slowly changing. Most lenders today use FICO 8, which is the snapshot model we've been talking about. It forgets the past. Only the current month's balance matters. But FICO 10T, the newer model, uses trended data. It looks at your balance history over the last 24 months. If you habitually run your cards to 80% and pay them off at the last second every single month, FICO 10T sees that pattern, and it adjusts. FICO 10T adoption is still slow. Most mortgage lenders and auto loan providers still run FICO 8, but it's coming. The good news: the strategy I've described works perfectly for both models. If your utilization is consistently low month after month, both your snapshot and your trend look excellent. This isn't just a one-month fix. It's a habit that compounds over time. Step 1. Stop treating the due date as the only date that matters. Find the statement closing date for every card you own. It's in the Statements tab of your bank's app or website. Step 2. Calculate your current utilization right now. Divide your total balance across all cards by your total credit limit. Under 10% is excellent. Under 30% is acceptable. Above 30%, you need to act immediately. Step 3. Set a recurring calendar reminder 3 days before each card's closing date. On that day, log in and manually pay your balance down to approximately 1% of your limit. Do not use autopay for this step. Step 4. Let the statement close. The bank reports that low balance to the bureaus. Your score reflects a responsible borrower. Then pay the remaining small balance by the actual due date to avoid any interest. Step 5. Do not close old credit cards, even if you never use them. An old card with a zero balance is silently lowering your utilization by adding available credit to your denominator. Put a small recurring charge on it, a Netflix subscription, a Spotify plan, set it to autopay, and let it quietly work in your favor. The banking system is built on rules. Most people only learn the rules about fees and interest rates because those are the rules banks advertise. But the rules about reporting dates and data snapshots are just as powerful, and almost nobody talks about them. By taking control of the snapshot, you stop being a victim of the algorithm. You become the person managing it. Try this for 1 month. Pick one card, find the closing date, pay it down 3 days early. Watch your monitoring app, Credit Karma, Experian, wherever you track your score. When you see that number move, drop a comment below with how many points you gained. It helps everyone in this community verify whether the system actually works the way I'm describing. If you want more deep dives like this, not surface-level money tips, but the actual mechanics of how financial systems work, subscribe. This is exactly what this channel is built for. I'll see you in the next one.